So what you can do is you can either go to LinkedIn's investor relations website, or you can go to sec.gov and look at the press releases and hard code or manually type into your model what all the numbers are. Or you can do something else, which is you can go to the website and you see in the top left-hand corner there, or on the left-hand side, it says export financials. What we can do is we can actually export the financials and then import them into our model and then build a model from scratch. So before we build the model, what I want to do is just give you a quick introduction to my model. And so I have always put a little introduction here to the model, what we're looking at. And then what we'll do is we'll talk about the revenue drivers, the income statement, the balance sheet, cash flow statement, and just how to value a company. And I'll break it down into very easy to understand components. Now, before we get started, I wrote here, please note that every model for every company is different. And so not all companies provide the same amount of data. You want to look at all the press releases and all the filings on the sec.gov website and listen to all the earnings calls and then just kind of build that into your model. Before I dive into the model, I always love looking at charts, and this is live data from the model, okay? I love looking for patterns. Pattern recognition is always great. And so this is total revenue for the company. You can see growth is great up to here, and this is the future we're going to forecast together. This is revenue for the first line item, enterprise, which is also called talent solutions. Looks pretty good. Marketing solutions, see that? Looks pretty good. And then the last section here is premium subscriptions, which looks great as well. And then we can look at the percent growth rate of change. And because this is a big publicly traded company, you see that growth is slowing, and that's perfectly normal. In fact, companies usually go public when growth is slowing. And this is another revenue line item. Growth is slowing here. And the third revenue line item is, ooh, what happened here? It looks like growth accelerated temporarily. Well, a good analyst would look into why, and you're a great analyst. So it looks like LinkedIn bought a company called lynda.com for $1.5 billion here in 2014. And that's why revenue spiked, okay? It's important to always understand why revenue is spiking, because usually growth is positive, but is slowing for companies that are big and publicly traded. And that's just usually what happens. And this year we got premium subscriptions slowing. That's actually a bit of a concern. Okay, so that's the revenue side. Let's look over here on the expense side. So this is operating margins, or basically revenue minus most expenses that are repeatable, okay? At least before taxes and interest, depreciation, amortization. So revenue minus most of repeatable expenses. And although revenue growth is slowing, we saw that over here, that might be a concern. It's okay because we believe, and the company didn't tell us this, we believe that the company will cut expenses, at least as a percent, and margins will expand. If this doesn't make perfect sense to you, don't worry, we'll cover in great detail soon. And sales and marketing as a percentage of sales, this is all data from our model, is going to decrease a little bit, right? So that'll help out to drive these higher margins up here. And then there's something called product development or research and development, R&D. That's going to decrease, we think, as a percent of revenue as well. And then same thing with general administrative. And you'll notice that everything in a model is just a percent of sales. And so modeling is actually pretty easy. You just got to have two rules in mind. Number one, everything almost is a percent of sales, right? So spend a lot of time working on projecting sales. And secondly, just look for patterns, man. It's not that hard. And then here we can see our EPS growth analysis, and it seems to be accelerating because we think the company is going to cut expenses. The blue line here is revenue from a model, and the light blue line, or I think that's light gray, whatever, is expenses, or I should say margins. And so although revenue growth is slowing, which is, again, is okay, it's a big company, margins are going to increase, which is normal. When growth slows, usually you get margins increasing.